One of the things that's happened is the central banks, Fed plus the ECB plus the BOJ, pumping a lot of liquidity into the global marketplace, which now is coming off gradually.
Yeah.
Can we take that liquidity back out and get to whatever normal is? I don't know what it is anymore, but if we get to normal without really cratering the stock market.
That's the great question. That's the fundamental question. And I think the answer is there is symmetry in the financial process. If repression, taking the interest rate down to zero for 9 years running, unheard of, or taking the long-term rates in Europe down to 30 basis points, or Japan 10 basis points, actually stimulated economic activity, then when you go in the opposite direction, it's going to unwind. In other words, the idea that there's asymmetry here, that we could push the rates down arbitrarily and make things better, but when we finally normalize, nothing's going to happen, is really, I think, wishful thinking.
Well, assuming, as you suggest, that we are heading to a downturn, maybe even worse than a downturn because of what's happened, are we better prepared for it this time? We're coming up with the 10th anniversary now of the great financial crisis. The banks have a lot more reserves, but are we actually still exposed because of the non-banks, because of the BlackRocks with $6 trillion now?
Yeah, I agree, because it's not the banks. I don't think it was then. It was Wall Street. But there's $15.2 trillion of debt on the household sector. They didn't delever one bit in the last 9 years because the Fed pushed interest rates so low that there wasn't any incentive to pay down debt. Now, here's what's going to happen. 170 basis point average increase in interest rates, let's say over 2 or 3 years, on the household sector would add $250 billion of interest expense to household budgets. How big a number is that? It's the same size as the annual tab for motor fuel and gasoline in the entire United States. Now, if you think that is not going to have an impact, I think you're dreaming. Secondly, this phony tax cut that Trump put through is front-loaded. It's crazy. The first year, $200 billion of cuts. By 2022, it's down to maybe 1% of GDP. By 2 years later, we're actually raising taxes. So the fundamental point is interest expense is going way up for everybody. Taxes are going up for the whole household sector, 155 million taxpayers. And when those things hit an economy that's this old, I mean, it's long in the tooth, we're 9 months from a record expansion, I think all hell's going to break loose.
The rationale right now is that everything that the Trump presidency has done will boost economic growth. And we have seen second quarter GDP just being revised up to 4.2%. Now, the rationale here is that all of that will also help shrink the deficit.
Yeah, that's just wishful thinking. 4.2%, we had 4 quarters since 2010 with 4% or better. We had 11 quarters with 3% or better. And then 2 quarters later, it's down to 1 or hardly anything at all. The 4% was an anomaly. 1 point of that was due to trade pull forward and soybeans and all the rest of it. Second part of it was due to consumers spending money that the Uncle Sam was borrowing to put in their pocket. That's a one-time thing. There is no acceleration. And Trump, crazy, 10th year of a business expansion is driving the deficit to $1.2 trillion, 6% of GDP. This is never heard of. Yeah. This would be considered absolute sheer insanity by anybody who can remember anything more than 4 years ago or 4 weeks ago. I happen to be one of those, and I know this is nuts.
There's no question it's unprecedented, but let me ask you about one specific aspect of their approach. What they say is because particularly they've expensed capital investment, that we're going to get an inflow of capital investment, which does seem to be turning around, that will actually increase productivity and help us grow our way out of it. What's wrong with that theory?
Yeah, well, the numbers don't possibly work. We're taxing 16.5% of GDP. That means that for every dollar of revenue loss, you got to have $7 of new GDP growth. It's not going to happen. Besides that, look at the orders numbers for CapEx, less aircraft and defense. They're more or less flat. There isn't any. You know why? Because when interest rates were driven so low, any project that could get financed got financed. In other words, there isn't a pent-up demand for investment capital because taxes were too high. This is just a gift to Wall Street, to the 1% and the 10% who are getting massive stock buybacks. This year, there's going to be $2.5 trillion of stock buybacks, dividends, and M&A deals. That's where all the money went. It didn't go into investment. It didn't go into growth.